So welcome to lesson 5 of the course. We're just moving along, and so far we've covered off a bit of an introduction to the balance sheet, the income statement, the budgeting, and then how all of those work together to provide you with good financial information as a leader in any organization, for that matter, not just in a not-for-profit setting. But as I've said to a couple of people, it doesn't have to be difficult. If you can always take it back to your own home finances and think about how you would think about your revenue and your expenses coming in order to manage your own personal budget, it just gets larger. As an organization gets larger, there just might be more accounts, there might be more expenses, there might be more revenues. But at the end of the day, it's the same principle to do personal finance as it is to do a business finance or a ministry finance. So this week we find ourselves going into financial analysis. And I often find that when we talk about financial analysis, that people often it becomes a scary topic in terms of how do I do financial analysis. But the reality of it is, it can be quite simple. I took a course last week on fundraising, and one of the things they really stressed was simplicity. Simplicity is not necessarily easy, but look for simplicity in what you're doing. Look for the things that are important to you when you're looking at your financial statements and the financial information that comes to you. But don't ignore anything that comes. Look at everything that comes. Try to understand what each of them are. You have consolidated information, you have departmental information, and you have that balance sheet. I cannot stress enough how important the balance sheet can become to you, depending on the size of the organization. The bigger you get, the more important it becomes. It is a key indicator of the liquidity of the organization, and so you really want to pay attention to that. Years ago, I remember dealing with somebody who wanted to spend money on something, and I said, well, we just don't have the money to do it. And their argument was, well, it's in the budget. Well, it doesn't matter if it's in the budget if your liquidity position tells you that you have no money to spend. And so you have to be really careful about that. You have to be able to balance the two. You have to be able to see where you've come from, what you have available to you to move forward. So when you're looking at financial analysis, it really gets down to that. So you have your financial analysis that looks at your income statement, your budget comparison spreadsheets that you can go line by line, see how I'm doing year to date. And when we talked about the budgeting course, we talked about having budget amounts even across the months, or really try to focus on where the revenues are coming in or where the expenses are coming in, and put them in those months. Because then when you get an income statement, a budget variance report, it's more meaningful to you because it tends to be more accurate to that point in time. And so that's, looking at the income statement, whether you have a profit or loss up to this point in time might not be the critical component. So you want to really focus on where your revenue flows are and where your expense flows are. And don't always get caught up on individual lines. It does matter what happens in the budget, because you may have expenses that are higher in one category and less in another category by the time you get to the end of the year. But it's understanding that, looking at that on a regular basis, and you'll start to get a feel and a trend for that. When it comes to the balance sheet, what becomes really important is what available monies do you have to spend. And monies aren't always in the bank account. Monies can be wrapped up in accounts receivable, and you got to have a look at that and say, what do I need to collect? What's not in yet? Have I billed everything? But there's a couple of ratios you can use. And I don't want you to get all hung up on ratios, but there are ratios. It's in the lesson material. We talk about the current ratio, which is current assets against current liabilities. And you certainly want to be into at least a 1-to-1 relationship. You don't want to be at a 0.8 to 1. You want to make sure that you have at least enough current assets to cover your current liabilities. But then there's the quick ratio that only looks at your liquid assets in the current assets, against your current. You'll see it in the course, but have a look at it. I hope you have fun with it. Even take your own financial statements and kind of look at the material that's in this lesson and apply it to your own situation where you find yourself in. Again, reach out to me anytime. We have that 1 hour on Friday mornings. You can drop in for 5 minutes, you can drop in for the hour, and we can just have a discussion, ask some questions. A couple of you have been taking the opportunity to do that. Anyway, good luck with this lesson, and just have some fun with your own financial information. Bye for now.